Welcome to this video on financial reporting for share-based compensation. If you're new to the Let Me Explain YouTube channel, then I strongly encourage you to subscribe to the channel, and you may even consider becoming a supporting member of that channel to gain access to all the videos that are available for the different CFA levels of exam and the different topic areas. Right, let's get cracking with the topic. Share-based compensation is relatively easy in terms of the accounting for it, which we're going to cover. Nevertheless, there are some little nuances that you need to know, and I'm going to cover all of this via the means of a really simple example. It draws on concepts already introduced in previous videos, things like, grant date, vesting period, settlement date. We talked about those previously, and I'm going to use those terms. So let's imagine a simple setup. On the 1st of January 2025, a company, let's say, grants 10,000 shares to an employee, and let's say this employee works in the marketing department. The reason why that is important will be explained in just a moment. Marketing department, right. At the moment those shares are granted, the share price in the market is $15 per share. And you may remember from the previous video that I said it is important to estimate the fair value of whatever you're awarding to an employee, and that award, the fair value, has to be measured at the grant date, and subsequent changes to the share price don't impact it. Something I will be indeed emphasizing as well throughout. Now, the grant is one thing, but then what you typically find is that there is a vesting period, and I'm going to imagine it's 3 years, so it's a 3-year vesting period, and it's only at the end of that vesting period, let's say 31st of December, so 2025, 2026, 2027 is, let's say, 3 years later, the award of 10,000 shares vests, i.e., that's when settlement happens, and the employee actually gets access to those shares. Those shares are transferred to them. Okay. Now, let's also make some additional assumptions. Let's say the par value of these shares is equal to $1 per share. Now, this sometimes is important, sometimes isn't in the examples that are in your curriculum. Sometimes you'll see shares being described as no par shares, i.e. not having a par value. Sometimes they will, and I just want you to know what to do, how to think about things when there is par value. It doesn't it's just a technical point. It will not change the substance of the example at all. But seeing as we've got the space to discuss it, I'll tell you. And let's say that all throughout, the assumption is that employee will stay in employment throughout the vesting period, in the sense that they will not leave the company before that 31st of December date when the awards vest. Okay, now let's take this step by step. First of all, at the grant date, which is that 1st of January 2025, that date which I have highlighted in yellow at the top of your screen, or the top of my screen, what you need to do is you estimate the fair value of the award. Now, in the case of shares being granted to employees, that's going to be relatively easy because you just take the number of shares, 10,000. Let's just check here. I said company grants 10,000 shares to an employee, and we've absolutely convinced ourselves, we think it's certain that the employee will stay in employment throughout the vesting period, so that we don't need to estimate some probability of them leaving, that kind of thing. And we multiply those 10,000 shares simply by their share price at the date of the grant. So $15 per share. Let me just show you. This is what I said the share price was at that date. So it seems that the fair value of the award is 10,000 times 15. That's $150,000. Now, let me emphasize, I said this, but I'm going to write it down so as to emphasize it, in a very strong way. That fair value based on the share price in existence on a specific date is only computed once. In the sense, once only at the grant date. Subsequent changes to the share price, throughout that vesting period of 3 years, the share price may, fluctuate quite a lot, but you will not adjust or update the fair value beyond what happened at the grant date. So subsequent changes in share price have no impact. Well, no impact on this specific grant from the 1st of January. What often happens is companies continue granting additional shares on some systematic basis. So maybe, every year there is a fresh grant, and of course, whatever is freshly granted will be calculated using the share price from that moment, but the grant from the 1st of January 2025 stays as it is. The only thing that you'll need to adjust for, but your curriculum doesn't even have examples for this, but just says it, is that you only make adjustments adjust for changes in estimates. For example, changes in estimates regarding whether certain conditions will be met, like performance here, the service condition, the fact that the employee has to stay in employment. But don't ever update that price. This is something they try to test all the time. They sneak in a price and they think they're going to catch you out because you'll update. No. You stay with whatever was there at the grant date. Now, a little bit more on the vesting conditions, because here the book sort of goes off on a tangent and says, these are vesting conditions. And I'll come back to the example, because we'll take it over to a financial statements template, and I'll show you how to account for this stuff in the example. But because I mentioned conditions, let me just tell you a little bit more about them. So your book splits them into service conditions, i.e. those relate, this is the most common type, and you don't have to know any implications from an accounting point of view of this. You just need to know that that this is how we split the conditions. So service conditions, the ones that you find most commonly, relate to the fact that the employee is required to stay in employment, so required to stay in employment, of course, with that employer until the vesting date, until the end of the vesting period. If they leave before, the awards are forfeited, so that they kind of expire, they get cancelled. On the other hand, we also have so-called performance conditions, and please don't treat them as a sort of either or type of thing. So it's either service condition or conditions or performance conditions, these are typically additional, if at all, they are additional to service condition. And they require, for the vesting to happen, for the awards to vest, they need a certain condition relating to company performance. For example, profits to be at a certain level or beyond a certain level, or earnings per share. So let me say, e.g. EPS, earnings per share target, some target must be exceeded or at least met. And a special type of performance condition would be a market condition, where the condition relates to the employers. The employer is, of course, a company, so employer's stock price achieving a certain level. Okay. Right, so a bit of theory on these vesting conditions, because you may get theoretically asked about them. Now let's go back to my previous example, the example which I started with numbers. So we've estimated the grant date fair value, and as I said, we're not going to update that fair value at all. Beyond this, we know that vesting, or the vesting period, is a 3-year period. That's how much, how long the employee should be in employment for to really benefit from the award. If they leave, the thing gets cancelled. So now let's think about the accounting for this. I'm going to go to my trusted financial statements template here, where I've got assets, equity, liabilities, and the income statement, but also other comprehensive income, So this will be a share grant. Now, I'm going to do everything in thousands of dollars, and as we sort of discussed before, loosely, what needs to happen is the award, or the cost of that share award, or any employee compensation, needs to be spread out over the period of service, employee service to which it relates. And here we've got 3 years of service. The fair value, which is estimated to be $150,000, 10,000 shares times their grant date fair value 15, 150, will now need to be allocated to the individual years. So year 1, year 2, year 3. Unlike with what you'll have to do when you get to defined benefit pension plans, here we don't perform any discounting. So the nice thing about this, it happens in a linear way. So that would give us 50,000 here, dollars, 50K over here, another 50,000, and another, of course, linear 50,000 over there. Now, because this employee, we were told as part of the example, works for the marketing department, their employee benefit costs, the cost of their compensation, be it their current salary or anything like the cost of share grants, gets expensed to P&L, to the income statement, on a sort of periodic basis. And that's the difference between somebody working in marketing or sales, for example, versus somebody who works in the production process, where their cost of employment, including this share-based compensation, would go to inventory and would increase the value of the inventory assets. So over here within the income statement, I'm going to write employee benefits, okay, and I'm going to create columns for year 1, year 2, and year 3. Well, I just showed my inability to draw a straight line. But the point is, every year the income statement would receive a $50,000, right? So this is all in thousands, hit, a charge for the relevant 1/3 of that whole package with a fair value of 150,000. Okay, whenever you do something to the income statement, positive or negative, it impacts your profit, and profit ultimately ends up impacting retained earnings within equity. So let me now, over here within the balance sheet, have year 1, year 2, and a final column for year 3. And I'll say, well, these charges to income or to profits impact our retained earnings in a downward way. Okay. Please note that there's nothing happening to assets in the sense that we're not, spending any cash on this at all. That's not what happens. Now, this is just simply showing the transfer of what happens to P&L over to equity. So in order for the balance sheet to balance, we must make some corresponding entry to keep the thing intact. We're not going to pay the employee money. If we were to pay them 150,000 in cash, we would see liabilities increase. But this is not going to be a cash payment. It's going to be payment in shares, stock-based or share grant. So what happens over here is we're going to have a special line called share-based compensation. I'm writing comp reserve. Reserve means reserve capital, a special sort of dedicated line within capital that's there to take the opposite entry to what you're doing to P&L and therefore retained earnings. So as you hit P&L and impacting equity downwards, there's an offsetting movement in equity that neutralizes this. It's called share-based compensation reserve. This is also the wording that your book uses. Now, after the 3 years of vesting period are over, okay, everything that was accumulated here gets transferred to share capital. Why? Because the shares are actually issued. And when you issue actual shares and the employee receives them, but this happens upon settlement, you look at a line called share capital, but also potentially share premium. And this is where this idea of par value comes in. I said, let's assume that the par value of a single share is $1. And when the employee receives 10,000 shares that are awarded to them, what happens is this share capital line increases by 10,000 shares times $1 each, so 10,000. And everything else, any residual, will be called share premium. Now let's think about what that residual could be. Well, over here we accumulated in this special share-based compensation reserve a total of 150,000. And now the time is ripe to, let me get rid of this line here, to take this out as a block entry. Let's take this out of the share-based compensation reserve and transfer it up here, but in the right proportions. 10,000 to share capital, where every issued share is recorded at $1, and the remainder 140,000. So as you can see, ultimately, the whole effect ends up impacting, or the whole issue ends up, and the whole share award ends up impacting our share capital and share premium. Sometimes in these questions they simply say, imagine the shares don't have any par value, which means you only take it to share capital without having any additional share premium line. But if they do, you now know hopefully how that works. In the meantime, you are impacting your P&L, impacting your retained earnings downwards, accumulating the offsetting effect, the growth in share-based compensation reserve, and then upon settlement transferring it all to share capital and share premium, but that's only when the actual shares are issued. The curriculum then proceeds to discuss various types of instruments used in this sort of share-based compensation or stock-based compensation, and these are simply sort of more specific details. So one type is what's called restricted stock. Restricted stock or restricted stock awards often associated with something known as RSUs, but as we will discuss in a moment, RSUs are a little bit more specific. There is another term here that may be used interchangeably, although not necessarily should be. That's performance shares or performance share units. Performance share units, and all of these are lumped together, but later on they say, well, that's not necessarily a good idea. So this is where the employee is awarded shares. This is award of shares, but with sale restrictions, in the sense that the employee cannot sell the shares until vesting date. That's when the restrictions on selling, the restriction is lifted. Another example of instruments used as part of stock-based compensation are stock options, quite popular, and we'll talk about them in a few minutes' time. This is the award of non-tradable call options on employer's stock as the underlying, but you can't trade these, you can't sell these on to somebody else. And additionally, and the curriculum doesn't discuss these as such, we have share appreciation rights. Often associated with the term phantom shares, but in detail these things sometimes differ from one another, but don't worry about it. This is the award of cash or indeed of shares based on the performance of shares. So how much cash you receive or how many shares received depends on how dynamically or how high the share price of the employer went up. So you're not getting shares as such, but you're getting something dependent on the rise in the share price. And the important thing here to appreciate is if the plan is not to give employees shares of the company, you would still measure the fair value of the award, but ultimately you would take it to P&L, but the other side wouldn't be equity, it would be part of liability. So it would be liabilities that go up instead of equity if the intention is not to give the employee any shares in the first place. And then, just one more, your book says there's also this thing called employee stock purchase plans. But this is a relatively sort of classic example under which employees are permitted. So this permits employees to purchase, but only some limited number of newly issued shares, newly issued by the employer, and newly issued shares at a discount to their proper true value. A sort of a benefit for employees only. Okay, good. Now, we're going to focus the remainder of this video on the two first types, restricted stock and stock options, starting, of course, with restricted stock. And the curriculum over here has quite a lot to say about what restricted stock actually is. So I said before that this is, this could be, this is the award of shares with sale restrictions, in the sense that the employee cannot sell this stuff before the vesting period finishes. And we also said they're also known as RSUs, restricted stock units or performance shares and that kind of thing. But there is a bit of detailed difference between these names, and you're expected to know this. I'm not sure really why, but you are. So restricted stock is basically stock that's subject to selling and sometimes other restrictions as well. A subcategory of this is performance shares. Performance shares, where with performance shares, you would call this, or you would use this name to describe restricted stock if the vesting conditions are based on primarily service, of course. So, you need the employee needs to stay in employment for a certain period of time, but there's also attached a performance condition. It could be a market condition, it could be a sort of profitability condition, whatever, but that is what makes restricted stock performance shares. Okay, it can't be just the service condition alone to be called performance shares. Typically, these things actually give you voting rights, so you're being awarded shares, and the fact that you can't yet trade those shares doesn't change the fact that you can vote using the rights contained in the shares, and they also give you participation in the dividend. So there's dividend participation contained as well, but they're subject to selling restrictions, so you can't trade them yet. Right? Now, another type of, let's say, restricted stock, or something that gets associated with it, is restricted stock units, or RSUs in short, and these are going to be similar to what we had above, but they are, for the time being, rights to receive shares upon settlement. So the difference is you're not getting any shares during the vesting period. During the vesting period, you're just accumulating or accruing the right to get shares once the vesting period is over and settlement comes. So RSUs, they are not actual shares yet. You'll only get the real shares when the thing finishes. So this is a bit like here. The settlement date, when it comes, the end of the vesting period, that's when the company creates new shares and gives them to the employee. Hence the entry went here to share capital and share premium. That's the typical sort of illustration for restricted stock units. And in fact, your book contains examples of just this. The rights themselves, so before you get the actual shares, which is upon settlement, the rights themselves carry no voting rights. There is no dividend participation built into them at all. And of course, they're not tradable either. Yeah. So, restricted stock, where you get actual shares, is at least you're getting shares during the vesting period. Here you're getting restricted stock units, which are rights instead of the actual shares. Now let's focus on the accounting for these things. Just like before, and this follows an example for RSUs that's in your book. First of all, estimate the fair value of those awards right at the grant date. Yeah. And if there are multiple awards being made across time, as is the example in the book, as far as I remember, every year there's a fresh award. Well, each time there is an award, estimate a fresh value based on the current share price. So this is based on current share price. And the example I did with you over here, even though they didn't say it's an RSU, this would be your typical sort of accounting for a grant that was based on the RSU concept. Estimate the share price and then estimate the fair value at the very beginning, and then take that fair value and, as step number 2, spread that fair value across the entire vesting period. For example, 3 years, yeah? And you spread it in such a way, like I showed, for an employee of the marketing department, you make an entry in the P&L, in profit or loss, in the income statement, a negative sort of charge, a hit, and that corresponds with something you do to equity. You go to that line called share-based compensation reserve, and you increase it. Sorry, didn't want to do that. Share. Oh, now I've spelled it twice. Apologies for that. Share-based compensation reserve. Sorry, compensation reserve. That goes up, and P&L goes down. Profit goes up, which makes retained earnings lower as well. So that's the two sides of the sort of the double entry. And only step number 3, upon settlement. So this is during the vesting period. The top line referred to what happens on the grant date. Grant date during the vesting period, and then finally upon the ultimate settlement, when the rights transfer to the actual issue, or materialize in the issue of actual shares, you transfer the amount that was accumulated in share-based compensation reserve. So this gets reduced, and you transfer that to paid in capital. And depending on whether you're told that there is some par value for the shares or not, it either goes to one line or it gets split between 2 lines, share capital and share premium, like I had over here. But the end of the end conclusion is that whatever was accumulated here gets transferred to these 2 lines, or a single line. Right. Now, very importantly, as I've already said, if the share price changes subsequent to the grant date, so during the vesting period, there is no impact on the fair value of the awards that have already been granted. So you continue to spread that out over the vesting period at the original amount. Any change to the share price only impacts newly awarded grants. And if you want, have a look at some of the examples in the book, and there are definitely questions in the book that test you on this, or in the curriculum in your electronic sort of learning ecosystem. Now, finally, let's just deal with stock options. So this becomes a relatively easy topic. You just need to make sure never to resist the temptation to kind of update the fair value. Stock options are non-tradable awards, so you can't sell them if you're an employee who received them, and they are typically set up in such a way that the options are at the money, meaning the strike price is equal to, or they say equal to, could be close to, the share price on the grant date. to be honest, I've seen a lot of stock options, and I've typically seen that the exercise price is higher than the share price on the grant date, because that gives motivation to try and increase the share price of the company. That's when the awards become really valuable to the employee, right? But I'm not going to argue with the writers of the curriculum. Once again, what needs to happen here is you have to start by estimating the FV, the fair value of this, in this case, the options on the grant date. Everything begins with this when it comes to employee compensation. And your book says, well, this is going to be more difficult than estimating the fair value of a share award, because for shares you just take the stock price from the grant date, from the exchange. Here you have to estimate the value of an option, so you'll typically need to rely on some option valuation model, and they say that the model has to be sort of a recognized model, but IFRS and US GAAP definitely don't tell you what model to use. So it's, for example, reasonable to use the Black-Scholes model, the Black-Scholes model, or however you wish to pronounce that, and that's absolutely fine. And whatever fair value you get, just like before, you then proceed to spread the cost or that fair value over the vesting period in pretty much or exactly the same way as we had over here. Employee compensation in P&L receiving a charge, and once again the other side of the entry being in share-based compensation reserve. Now the difference is what happens upon settlement. Okay, because there are two possibilities here. Upon settlement, the options may either be exercised by the employee or indeed not. So if the options expire unexercised, because the employee has no incentive to purchase at the strike price shares of the company if the stock price is lower than the strike price, right? Then any amounts that have already been taken to share-based compensation reserve, they just stay there. You don't move anything. So throughout, let me take a fresh template, right? You estimated the fair value of the stock options at the grant date. Let's say that was, 90. There's a 3-year vesting period, so you split it into 30, 30, 30 per year. You hit the income statement, employee compensation, employee benefits with 30 per year. But also, obviously that was impacting your equity in the sense that retained earnings were getting that hit of 30, 30, 30. Whatever goes to the P&L, the income statement, ends up impacting retained earnings. And to counteract that, or to cause the balance to stay within balance, in a state of balance, you were doing entries to share-based compensation, 30, 30, and 30. And before I said, upon settlement, when an employee actually receives the shares because the conditions have been met, the vesting conditions have been met, you transfer all of that to share capital. But here the problem is, if ultimately the employee never exercises their right to purchase the shares from the company, there's nothing automatic about this, right? Those options may expire unexercised. This amount that's been accumulated over here, so that entire 90 just stays within that line and doesn't get transferred anywhere. On the other hand, if the options are exercised, then it still means that the employee will pay something to the company, because in order to exercise an option, the option gives you the right to purchase shares from the company, so you still have to pay some cash for it. So whatever cash gets paid in here by the employer, right, together with this amount that's been accumulated under share-based compensation, both of these go to capital, paid in capital, potentially with that split into share capital and share premium, or just a single line. So this amount X, whatever has been paid for the new shares by the employee, goes to this line, and this entire 90, in my example, that's accumulated under share-based compensation, leaves and is transferred up here as well. So the amount you show under paid in capital is composed of those two elements. And there are some numerical examples for this in your book. They're a bit sort of unnecessarily complicated, but hopefully you kind of get the picture. Whatever was the fair value of the award, the options awarded to the employees on the grant date, gets transferred out of share-based compensation where it now should have accumulated. That gets transferred to paid in capital, together with, critically, whatever the employee pays to receive the new shares. And because they've exercised their call options, it must mean that the current share price is lower than the strike. But this is the price, the strike price, paid by the employee. And that's additionally what's accumulated in equity over the vesting period.